Good morning and welcome to this Wednesday, August 18th, 2021 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, kind of not a great start to this week, Monday and Tuesday. I mean, both days, the bulls had to battle back from some pretty deep deficits to start the day. But the good news is we did bounce back. Seems like the market probably has kind of reached, seems like anyway, it's reached a point where it needs a little bit of time just to consolidate the gains that we've seen. It's not like we've seen a lot of gains, but it's just been kind of that steady move to the upside. And so at least in the short term, I think the market is just trying to unwind some of the overbought characteristics that are pretty evident in the market right now. And so we're just going to have some patience. It's also option expiration week. Options expire on Friday. And then, of course, next week, got the week after options, which historically can be a problem. And then on top of all that, we got a September coming up. And September, if you go back over history on the S&P 500, it's about a 50-50 proposition. Will it go up? Will it go down? It's the only month that's 50-50. Every other month in the year does have more of a tendency to go higher. So, I think seasonality is going to play a role. I think options could play a role. I think overbought conditions could play a role. But make no mistake, we're in a secular bull market, and betting against this market, trying to make money on the short side, personally, I think is much more difficult than trying to make money on the long side. Rotation continues to be an issue in the market. Trying to figure out what's the next area is not easy. If you look at the long-term relative strength picture, the aggressive areas continue to clearly be the preferred choice. Yes, the last few days we've seen some of the defensive areas, but for the most part, we are seeing aggressive areas lead this market higher. So anyway, we got a lot of stuff to go over. I'm going to start off here just taking over to Earnings Beats. Those of you who are new to Earnings Beats, love to have you join up for our free newsletter. Just scroll down on our homepage. You'll see it here on the left-hand side. Letters couldn't be a whole lot bigger. So, just type in your name, email address, hit that subscribe button. We'd love to have you join our community. It is completely free. No credit card required. You can unsubscribe at any time. We're not going to give you any grief. But I think you'll enjoy the newsletter. It's educational. We try to put trading candidates in there from time to time, but mostly we focus on relative strength, earnings related information on the charts, lots of gaps and so forth, and just trading strategies, things to hopefully help you improve in your trading. So again, just type in your name, email address. We'll make sure you get on that list. It is published 3 times a week, Mondays, Wednesdays, and Fridays, typically out well before the market opens at 9:30 Eastern. So normally 8 to 8:30, it's out, sometimes earlier. But make sure you go to earningsbeats.com, check that out. We've had a really busy week already with webinars. Got another huge one coming up tomorrow night. It will start at 5:30 p.m. Eastern, and it is a members only event. It's really I would say probably the biggest webinar of the quarter. Each quarter, it's where we announce the 10 equal weighted stocks for each of our 4 portfolios, 3 of which have done a really nice job versus the S&P 500 over time. One, the income portfolio, still lagging. We beat the S&P last quarter pretty soundly and took a slight lead since inception, then we gave it back this quarter. So that one's fallen behind a little bit, but the other 3 are still well ahead of the S&P 500. So we will be announcing the 10 equal weighted stocks that go into each of those 4 portfolios on Thursday evening, starting at 5:30 Eastern. So if you want to be part of that, all you need is a trial membership. You don't need to be a full-fledged member, just a trial. And it's no cost, 30 days, no cost whatsoever. So I would love to have you if you want to make the event tomorrow and check out our service. All right. Well, I mean, you can see the damage, a little bit of damage that's been done on the charts the last couple of days. The Dow Jones Industrial Average, which, we did manage to reverse on Monday and close up at a new all-time high, But yesterday we saw the weakness kick in again. We came all the way down to the 20-day moving average. We did bounce off of it, so that was a good thing. But just, if nothing else, we now have a short-term pattern of lower lows and lower highs on our major indices. And that just suggests that we could be in for some more selling. I know we've bounced back these last 2 days, but don't be surprised if maybe we're up in the morning and then fall back later in the day. That wouldn't be a surprise in one of these short-term downtrends. But you can see Dow Jones Industrial Average still in an uptrend, still looking good. AD line strong. S&P 500 was down 31 yesterday, down almost 0.75%. But it beat the alternative of where we were trading earlier at the low on Tuesday. We were down at that 20-day moving average all the way down at 44.19. So nice recovery off of that. Again, that AD line very strong. NASDAQ struggled, finished below its 20-day moving average for the first time in probably a month or so. AD line still strong, though, even with the move down. Part of the reason that the AD line keeps going up is these afternoon rallies. So you go down intraday, but then you come back up and you close in the upper half of a candle. If you close in the upper half of that day's candle, that's the multiplier, where you close relative to the high and the low. If you're above the 50%, that middle part of the candlestick, then your multiplier is going to be positive times the volume that day, and it just simply gets added to the AD line. So that's why these AD lines are going up, even though the market's been going down the last couple of days, is we're still seeing these rallies, these afternoon rallies, which reek of accumulation. And I would continue to watch this. I think if we do pull back, one of the things I'll be looking at and analyzing is how much of it is actual selling during the day versus how much of it is just a gap down at the open. The last 2 days, it's looked pretty ugly early in the morning, but we've rallied back and it hasn't turned out to be that bad. I think there's accumulation continuing to take place. Mid caps and small caps both down more than 1% yesterday. Small caps clearly the laggard, not only on the chart, which I think is pretty clear, but also on the AD line. We're not seeing that same strong AD that we're seeing on all of the other 4 of the major indices shown here. All right, looking at the sectors, healthcare, actually all of the defensive groups did better again on Tuesday, but that's not unusual. When the market sells off, that's normally what happens. What I'd be more concerned about is if all of the major indices went on a tear for the next month and was led throughout the entire month by defensive groups. That would tell me that the market is rotating into areas that we should not feel very good about. But, and I see a lot of folks writing and saying, well, we've got defensive groups leading the market. That's bad for the market. Well, it's not. It's normal when you're selling off. When the market's going down, that's normal. But what wasn't normal was the beating that discretionary stocks took yesterday. We're going to talk a little bit about that in just a bit. But discretionary stocks were weak. It seemed like discretionary stocks were being hit by multiple sides. A lot of things going on yesterday that the market didn't like, and it really took its frustrations out, I guess, on the discretionary group. Materials also weak yesterday, went down, did test the 20-day and held, so that was a good thing. This is a group I'm not feeling great about, but we'll just kind of keep watching it. Industrials, this is a group I do feel pretty good about. Nice reversal. We held the 20-day there. Also, we had struggled to get through 104 for about 2 or 3 weeks here, and we finally went through 104. So it was nice not only to hold the 20-day, but also to hold 104 on the close. That'll be a level short-term to watch on the XLI, because you've got that rising 20-day coming up at 103.87, and then you've got price support in the near term at that 104 area. Energy continues to weaken, as you can see here, rolling over. We did go below 48 yesterday, which was the first time we've seen that since we had these 2 candles on an island. That was an island cluster reversal. So you come down, you gap down, two candlesticks print on this island, then you gap back up. You leave these 2 on an island. That is a short-term reversal. We did reverse off of it, went up to the 20-day. We failed. Now we're starting to roll back over again. I would still continue to watch this 46 level. 10-year Treasury yield. First off, we do have the housing starts out. Housing starts and building permits came out for July. So we needed some good news after yesterday, because home building, that's one thing we'll look at here in just a bit. but home building had a rough day yesterday. Housing starts came in at 1,534,000 units. Unfortunately, market was looking for 1,610,000 units. So we did fall short. It was also a pretty big drop from June, which was at 1,650,000 units. So almost probably about an 8% drop or so, maybe 7% drop from June to July in housing starts. Not great. However, building permits, which is more of a sign of things to come, actually beat expectations. So a little bit of a mixed report this morning. July building permits came in at 1,635,000 units. The expectation was 1,620,000 units, and June was 1,594,000 units. So the housing starts came in weaker than expected, but building permits stronger than expected. So we'll see how that plays out in a bit. But let's go ahead and talk a little bit more about, and by the way, the 10-year Treasury yield on that little bit of economic news today is up slightly, up about 2 basis points. We'll see whether or not we can start to move back to the upside here. But let's talk a little bit about the XLY, because the XLY was beaten up pretty good yesterday. Fell back below the 50-day moving average for the first time in a couple months. That's not good. I would just be watching a couple of levels, and I'm going to pull up a 2-year chart here. And one of the things that I like to do is, we have a pretty significant trend line on the upper side already cast in stone here. So if we take the highs pre-pandemic and we connect with the highs throughout 2020 and 2021, you'll see that that's right about the upper trend line. Now, what I like to do is I like to grab that and start and drag it down and see if there are some key support levels. Now, we had a pretty good low in June of 2020. It's like a double bottom right here. And then the last real significant selling we've seen in consumer discretionary stocks occurred February to March. It's where a lot of the growth stocks got hit really hard. So that would make sense that that is also a pretty key low. So if we, just track this, because this seems to be, some will look at this and let me pull up a different, choose a dotted line. I mean, some will look at this and say, oh, when that breaks, that's bad. Well, the XLY went from 80 to 135 in 3 months. That slope is not sustainable. And usually when you come off of a massive bottom like this, and then you have a quick recovery, if you try to draw trend lines from that bottom to any of these on a daily chart, it's just not going to make sense. You're just constantly breaking down because you're essentially connecting 2 points. You're connecting this point and then whatever other point you want to arbitrarily connect. And it just looks like one breakdown after another. Don't do that. This is a major low to be used on the long-term weekly chart, but not on the daily chart. Avoid doing that. So here, what I do is I just say, okay, these seem to be the more rational highs. And maybe some of you think they're irrational because of everything we went through. That's can be debated at a different time. But I think when we take the key highs on a daily chart and you connect them and then you drag the line down and find some key lows, that gives you a fairly reliable channel that we've been in. And this one is a little bit more sustainable because we're not going up 60% in 3 months. When you're going along here from this high over here 3 or 4 months later, you're going nowhere. You got these series of ups and downs. So anyway, 170 is about where we come in right now. I'm just going to draw a couple support lines because I think the low that we just had around 174 back in July, I think that's short-term something we want to pay attention to. And then we had this double bottom back here in May, where we also had the inflation reports coming out that were horrible. We saw a lot of the growth stocks, a lot of discretionary stocks get hit. So I think these are the two lows. I'm going to say 165 to 174. If the market really weakens here, this is a range that I would be looking for. And if we go down to 165, probably what we're going to be doing is just adjusting the channel. If we break this channel, then what I would probably be looking at doing is connecting. Let's say we go to 165. Then what I would do is maybe connect this low over here to 165 and then simply get rid of this and take this and maybe drag this up to, I can get one, here we go. So maybe drag it up to the recent highs, and that might be the new channel. Just because you break a channel doesn't mean you're going into a bear market or that the bull market's ended. It just means that the trajectory is probably changing. So that's what I would take out of this if consumer discretionary were to break down below 174. If we don't, then I think that prior trend, which comes in at that 170 I was just showing, I think that that channel line at the bottom at 170 continues to provide us great support going forward. Anyway, just wanted to point out a few of those things because the XLY got hit really hard yesterday. And I just think you got to keep things in perspective. The chart has not broken down. You can say, well, yeah, but it went below the 50-day. Well, we break down below the 50-day a lot of times. Look at back in February, March. I mean, we were clearly well below the 50-day. A month later, we were clearly well above the 50-day. We didn't take out these prior lows. So, I think as long as we continue to set this pattern, higher highs, higher lows, higher high, higher low, higher high, you really don't want to give that low up at 165. I think that would begin to change the dynamics of the consumer discretionary group. So what happened yesterday? What was going on with consumer discretionary? Well, first we had the retail sales report out for July, which came in way below expectations. And so, of course, retailers, which are a big part of not just the consumer discretionary group, but our economy. I mean, retail is a pretty big part. And it was not a good report. Doesn't mean next month's not going to be a good report. We've been kind of flip-flopping. But I think that combined with the Delta variant and the rising cases of COVID again, I think all of that's just putting pressure on the group. We're sideways consolidating. I would watch the 90 level on the XRT. We're at 92, 97. I think as long as we hold 90, we're fine. And maybe even we could go all the way back to this low, because once we went to this low, the new high was set, and then we came down to this low. But prior to this high, this was the low down around 88. So I could make an argument even down to about 88, we're okay on the XRT. Beyond that, then it would start giving the signs to me that we're rolling back over again, which would not be a good look. Next up, home builders, home construction. So home construction yesterday down 3.7%. We did bounce a little bit off the lows, the intraday lows, but we did fail to hold the 20-day moving average. Good news is we're still in a cup. Just because we went down yesterday doesn't negate this cup. The only thing that would negate this cup at this point would be a close below this double bottom at 1400. We still have plenty of room there. So I'm seeing an uptrend. I'm seeing a cup. So I'm seeing a bad day. I'm not looking at this as anything worse than right now, just a bad day. Could it escalate? Sure. Market can always sell off. If it escalates and the market sells off significantly, and I'm talking, 3 to 5% from here, then I would think home construction probably is going to go back down to that 1400 level, or at least threaten it. Maybe go down kind of like this low over here, just a little bit higher to keep that rounded bottom intact. But I don't see anything horrible at this point. So let's move on now to the autos. Seems like as soon as the news came out about the government investigating the safety of Tesla vehicles, the group as a whole came down. This group looks a lot like the Tesla chart. Tesla is a big part of this index. So had the huge run, came back, held some pretty key lows here around 750 on the auto index, got back up to some key resistance a little above 900. Now we're back in this range. I would say around 825 is pretty good support from the lows in July. So I'd like to see it hold there. But auto still long-term, short-term, maybe intermediate term. I'd say it's more neutral. Long-term, still very bullish. We had a huge move up or sideways consolidating. I don't know how long this goes on, but sideways consolidation is not bearish action, especially after we moved up as far as we did. 125 to 1100 in less than a year. Give the group some leeway here. All right, other areas of specialty retail, or of retail, I should say. We'll start with specialty retail. Specialty retail still trying to make this breakout, coming back down, testing that 20-day, sitting almost right on the 20-day. I just think short term, we're going to have to try to hold on to about that 2660 area, which was the low back in July. I think as long as we do that, we're fine. Next up, broadline retail should be getting a boost here from Target today, although Target was down after a great report. I mean, Target blew numbers out of the water and raised guidance, and the stock's down. But we've built in a lot of really good stuff in the report. And that's one thing you have to understand about earnings season is sometimes you get these companies have huge runs. And I'll show you Target in a minute. But you have companies have these huge runs, and then it simply doesn't matter what the news is. They just need time to pause and catch up. Broadline retail overall, though, you can see breaking down below the 20, below the 50. The 20 is now below the 50, which is that death cross. The PPO is in negative territory. I don't think that this is going to be a long-term thing, but you have to respect the negative, the bearish implications of the structure of the chart right now. So I believe we're going to be fine down the road. We came up here, put in this low, and then broke out. So I think as long as we hold 3,200, we're fine. You could even make an argument all the way down 3,000, although that would be painful from 3,400 down to that 3,000 level. But this was the sideways consolidation. This was the low. There was the breakout. So technically, we're still in an uptrend as long as we're holding those lows. Let's look at the clothing and accessories group. Big drop, almost 4%. But like broadline retail, I would be watching these prior lows. I mean, we have higher highs. Going back down, testing those prior lows. We did it in July, testing May and June. We could potentially do it again. I mean, you don't want to do it, but when you're consolidating, you go down, you come back up. You can see we did this in March, went down, tested that level, previous level. So I wouldn't rule out a test of that 380 level, although we would need to see some additional selling in the overall indices, I think, for that kind of a move lower. Apparel retailers trying to make the breakout, putting in a little bit of a handle. So right now we have a cup and a handle. Starting, you don't want the handle to go back more than 50% of the depth of the cup. So let's just say 1,300, 1,150, or maybe 1,320 to 1,150, 170. So 85 from there would be down to 1,235. We're at 1,253 right now. So we don't want to lose a whole lot more ground to consider this a handle. But a breakout above this double top up here would be very bullish. Home improvement. So Home Depot came out with earnings yesterday. Market didn't like it, even though they beat on their bottom line. It did show that customer purchases was down. And I think, coming off of the huge run that we had March through May, I think it's just continuing to consolidate. Watch the low here, 650. Watch these previous tops, 625. I believe home improvements will find a low somewhere if we go down that far. 625 to 650 would be the floor there. And then one of the strongest areas of the market has been footwear. And footwear, like Nike, which I talked about last night in our Max Payne, as we've gone up, you can see that the PPO is struggling. So we do have a negative divergence. Sometimes we get those after a huge move up because the PPO goes up so fast and so furious. Even though we're having a decent run, it's just hard to put in a higher PPO after you've made a huge run. It's just the math behind it. So I would be careful about getting too bearish. I would be a little bit more bearish if we lose the 20-day moving average. So maybe that's something to watch for. All right. Let's take a look at a few earnings reports out. So first one I'm going to pull up is Agilent. So this one is in the medical equipment group. Medical equipment has really started to strengthen here. You can see on a relative basis, medical equipment right now is broken out to about a 6-month relative high. Excuse me. So we got this breakout to a nice 5-6 month relative high. And Agilent is a strong performer within the group. They came out, they beat 110 versus 99 cents. So easy beat on the bottom line. They are up in pre-market. Last time I looked before the show, they were up a little over 2%. What I would be careful about, I mean, AD line is off the charts. I mean, this obviously is a company that seems to be under heavy accumulation. It's a leading stock in a leading industry group. That part is true. What I would be careful about is if you get something like this over here in February, that would have been an earnings report. big volume, you gap up, and then you print this reversing candle. That could lead to short-term weakness, especially with so much positivity built into this chart already. I'm not saying that we're going to get that kind of a candle. I'm just saying if we get one like that, I would be careful with Agilent short term. Long term, any kind of a pullback, if we did pull back, say to the 50-day moving average, that would just be a great opportunity, I think. What else? ALC, big reaction here. This was the biggest positive reaction I saw in earnings last night and this morning. Alcon stock is up. Last time I looked, up almost 12% pre-market. Expected to post 43 cents. They posted 56 cents. And every company I looked at, by the way, this morning, I think there were 10, 12, 13 of them. All 13 beat estimates. 13 for 13. Anyway, this move up at 12% is going to be a breakout above all of these tops. So that would be good news because you got this up move, sideways consolidation, and then we get that breakout. So ALC will be one certainly to keep an eye on as we go forward. Another one, let's actually move into some of the, well, we do one more from yesterday because Cree was getting hit pretty hard. This one was down 8% in pre-market. They actually beat. They were expected to lose 25 cents. They lost 23 cents. But look at the relative strength of Cree versus the semiconductors. Down near 52-week low. Been trending down for months and months and months. Look at the volume. When the volume's been heavy, what do? We sell off. The AD line, well, we're starting to strengthen a little bit, but I mean, literally just four weeks ago, we were near 52-week low on the AD line. There's just too many issues with this chart heading into earnings. I would not have felt comfortable. And now we're getting the gap down. We're going to open at a new low. I think, maybe look for a reversal down 75. That was the breakout with heavy volume. But I don't like to try and catch falling knives. I would much rather find a solid stock that pulls back rather than trying to catch a bottom on a stock that seems to have no bottom. All right, this morning's earnings. Let's pull up Lowe's. So Lowe's in the home improvement. Of course, we had Home Depot yesterday. We get Lowe's today. Lowe's beat 4.25 versus $3.99. Stock up 4% pre-market, but it was down 6% yesterday. So it's just getting back some of what it lost yesterday. Right now, this group is just struggling. Look at the AD line. That also tells me not to trust a gap up. I mean, because the way the AD line goes down is that you're closing in the bottom half of candlesticks. So the last thing I would want to do in a stock that looks like this is to chase a gap up. So I'd be careful with Lowe's. Target, this was a big report. 364 versus 348. Stock down 208, 2.08% pre-market. And it's been coming down, but this is a solid AD line. Talk about strength and leaders in that broadline retail group. There aren't many out there, if any, stronger than Target. It has just been straight up, very little move to the downside. Wall Street loves this company. And I think the gap down is probably going to present an opportunity. If it gaps down and trades down, even more than 2% intraday and then starts to rally, that could be your cue. Target, I think, still looks very, very good here. Let's do Children's Place, PLCE. This is a smaller company. Stock is down 6% in pre-market. They were expected to turn in a 50-cent profit. They came in at $1.71, and the stock's down 6%. But that 20-day moving average is about 6% below current price. So if it gaps down 6%, you may see a bounce off of that 20-day. I mean, the AD line's strong, which, unlike Lowe's, tells me if you get a gap down, that might be the time to buy when you got a stock that's continually putting in higher and higher AD lines. All right, let's move on to the three you must see. First one, Home Depot. Of course, I mentioned they reported yesterday. Nice little doji right on the 50-day. This AD line, unlike Lowe's, the AD line here is strong. So when you gap down, many times that's an opportunity. Look at the gap down here in the recovery, these hollow candles. Back here you see some big red candles, but for the most part, we haven't seen a whole lot of red candles. So I think Home Depot is being accumulated. We could potentially go down to that 300 level, but I believe it holds and eventually turns back to the upside. Next up, these, by the way, were the three worst performers in the Dow yesterday. Boeing down again today. We just opened, by the way. Boeing, just, it's been a struggle. Aerospace, really one of the worst performing areas, unable to get back to where we were in the, pre-pandemic. And if we pull this chart up, you can see a 2-year chart where Boeing was prior to the pandemic, 350. And where are we now? 221. We're still 130 points from where we were pre-pandemic. So I just think, and look at the AD line. I mean, there's no signs of accumulation of this stock yet. It's going nowhere. Its relative strength is horrible, and its group is horrible. So I always talk about leading stocks and leading industries. This is the polar opposite. Stay away from Boeing. It's just not worth it yet. Listen, it's a great company. It will be fine. Long term, if you wanted to buy it and hold it for 20 years, 10 years, it's probably going to be a great investment. Short term as a trade, no thank you. Last one is Caterpillar. Caterpillar starting to strengthen again, pulled back, hit that 20-day, currently today down another 77 cents, roughly a third of 1%. I wouldn't be surprised to see a cup form here. I like the fact that we went up above this reaction high before pulling back to the moving averages. Another high above the high we just saw a week ago would be really bullish. That would really start to give us this look of this cup. So I'd be looking for that. I think the AD line's been pretty strong, even though we're 30, 35 points from the high. We're not that far from setting a new high on the AD line. On a relative basis, CAT, not so great. I'm going to give you one more chart, and this is Deere, which reports on Friday in the same space. Deere, you can see, almost did get back up there. The AD line also is still pretty strong, and look at the relative strength here. So give me the choice, Deere versus Caterpillar. I'm still going to stick with Deere, although you do need to know Deere reports earnings on Friday. So I got to be willing to take on that risk. All right, that is it. Let me pull up the major indices, see what's going on here early today. NASDAQ showing just a little bit of strength down, the S&P both down, small caps, mid caps both down. So a little bit of a mixture. I mean, looking at NASDAQ, we're showing a little bit of a continuation of the rally we saw yesterday afternoon. Maybe pull up the S&P and see what's leading and lagging. There's Target down about 2%. Lowe's up 4%. On that earnings news. We'll see if it can hold it based on that poor AD line. And Moderna continuing to move up. There's Agilent. Didn't take long for that one to jump up more than 2% this morning. And Tesla getting a little bit of rebound. Tesla's been hit pretty hard, so maybe the autos are set for a little bit of strength. We'll see if we can continue it throughout the day, though, on Tesla. All right, that's it for me. Everybody have a great day. I'll be back tomorrow over at Stock Charts TV, which you can see right there on your screen. All you got to do, go over to stockcharts.com and click on Stock Charts TV at 9 a.m. Eastern, Tuesdays and Thursdays. That's when I do my recorded shows over at Stock Charts. So you can check that out. But again, that'll be at 9 a.m. Eastern tomorrow. Everybody have a great day. Don't forget, check us out at earningsbeats.com. Big event tomorrow with our top 10 stock picks, the draft. I like to call it the draft, where I get to pick my 10 favorite stocks for each of the 4 portfolios. Looking forward to that. Would love to have you. Everybody have a great day. Happy trading.